before I even go into the slides in the presentation, I'm probably as bullish or as optimistic the market as I ever recall being. Now, I want to have a shred of caution with that, because at the very same time, we're looking at incredibly positive numbers on the beef side, but we can't ignore the fact that we are having some stress into the overall macro economy. If I had to, and it's not the focus of this presentation, but just to lay the groundwork, I think we have a very real risk of a recession sometime in 2023. The warning signs that we're getting, the biggest one is the inversion of the yield curve, where 2-year rates are running higher than 10-year rates. That's typically a really strong indicator or lead runner in front of recession sometime over the next the following 12 to 18 months. The second cautionary flag that we're seeing is that we're seeing a really rapid run up in credit card debt, that consumers clearly, as we've seen throughout from the post-COVID recovery and through the holiday season this year, consumers are still eagerly spending money, and will probably be forced to see that slow down sometime before this is over with. The third cautionary concern I have, we are seeing an escalation in the number of reported layoffs. That had, at this point in time, that's predominantly been in the software, in the tech industry, and I'm not sure that whole sector wasn't overheated to start with. Here's the point I want to make. I think there's some cautionary flags out there. Our perception at this point in time is, if we do see a recession, we're not expecting for it to necessarily be severe, nor are we looking for it to be long lasting. But it is just to get on here and talk just how incredibly bullish the market is. I needed to get that said. The other is a point that I needed to bring up right off the bat. I'm proud to be with you today representing Terrian. And Terrian is a startup that we first started this project, went public in November of this year. And it is a new market research firm that we are the results, or sponsored by a sponsorship of American Ag Credit, Farm Credit Services of America, and Frontier Farm Credit. And so besides the American Ag Credit sponsorship, I certainly hope that we'll be able to share more of our market information with you in the future. And with that, I will actually go to get started. Okay. All right. With all the introductory conversation out of the way, and the comfort that we do have slides up, the first conversation we need to have is clearly, and as was noted in the introduction, you guys have been the beneficiary to date of some really solid precipitation through December and so far in January. Here, I'm in St. Louis, and we're not in bad shape here, but if you go just west of us and go through, Texas has had some improvement, but primarily Oklahoma and Kansas, we're still seeing extremely heavy drought pressure. Across the U.S., we're currently working with basically 67% of the U.S. cow herd is in areas of some degree of drought stress. And the point two points that I would make with this is, the first one is, I think it's comfortable to say, and there's a lot of people that are way better educated in weather than I am, but I think the evidence is growing that we are working out of the La Nina situation, starting to see it neutralize. How long we are set in that neutral range, before we actually get into an El Nino. But I think I was slow to buy into it, but I think we're to a point now that we are seeing some substantial improvement in precipitation. You know, in our, while we were on earlier today, California conversation, California is getting hit incredibly hard again today. And hopefully some of that comes over and you guys get some more of that rain. Here's the point. I think that we're just seeing the very beginning of the evidence that the appetite for heifer and female retention is beginning to surface. Now, our expectations are that with the massive liquidation that we have seen through 2021 and especially 2022 that I'll go into detail here in a second. But our view at this time is that there's still enough drought stress out there that we're anticipating another round of cow liquidation in 2023. However, we're expecting it to be very small in relationship to what the record cow slaughter that we saw in 2022. So when you look at where we're at with cow slaughter, I really think that we need to go back to the last cycle low, and that was that January 2014 cattle inventory report that had beef cow inventory. I think it was at 28.7 million, and all of the modeling work that we did at that time, and even leading up to this year, we thought we had seen enough recovery and support to the demand base in the market that think we had seen enough stability in the processing sector. We didn't think we would ever see the beef cow number that low again. Our projections for this year, or for 2023, is we're expecting to see a beef cow number at 28.9 million head. If we see another round of a modest liquidation in 2023, as we're anticipating, we'll take out that 2014 low. So we're looking, starting this recovery cycle, allowing that we have cooperation of Mother Nature. But we're starting from an incredibly tight level of beef cows. And from our high point of cows in 2019 at 31.7 million to the 28.8 that we're for in 22, and then the additional decline we're expecting in 24, we've seen just short of 3 million beef cows pulled out of the system. Over that same time, we've seen very limited decline in dairy cow numbers. We really typically, in the last 10 years, we typically don't see more than 500,000 head change up or down in that dairy cow number. So, you know, I repeat myself, but we're expecting to, by the end of 23, early 24, I think that we are going to be looking at an incredibly explosive situation in cow numbers. I'm basically talking about the same thing, but to look at weekly cow slaughter that we had throughout 22, you can, for much of the year, we had weekly cow slaughter running 12.5 to 13% over the 2021 level. And as when we went through the first and second quarter of last year, there was a lot of speculation in the marketplace that when we got to the second half of 22, we would see cow slaughter decline precipitously. It just didn't happen. And you can see from this chart with the green line there just how aggressive. Now, finally, when we got into the holiday period post-Thanksgiving, we did finally see some a couple of weeks where cow slaughter was below the 22 level, and that's what's pulled us down from a 12% year over year increase in cow slaughter to 11.4. I think one thing that has made this drought cycle so impactful to the market, and I try to make comparisons to where we were in that 2011, 2012 drought period, is at that time we were pretty much dry everywhere at the same time. This drought cycle, while we were dry in the southern plains and central plains, we were stressed, but not. If you take the drought pressure throughout the West and the massive cow liquidation that we saw in 2021, Montana, Wyoming, Colorado, all that Intermountain region, and then that drought migrated south and east, and so we basically have split this one into two separate sections, and that has caused this prolonged. The other thing that I think is a huge driver in the liquidation that we've seen throughout 2022 is when we have hay prices at the levels they're at today, in excess of $250 to $300 a ton. They're just, a lot of these guys that have fought the weather and tried to hold on, just got to a point where the classic case of out of hay and out of money both at the same time, and had to give it up. So not only have we seen that pressure and that liquidation on the cow side, we saw the number of heifers on feed and the percent of heifers to steer slaughter throughout this past year, of heifers running at 0.660 to 0.70 of steer slaughter. And you can see the range we've had in recent years, but you can also see the black dash line there where we're at on a 5-year average. When we look at the rate of heifer feeding and heifer slaughter, it's actually been more aggressive than the rate of cow slaughter. There's just the cow slaughter was way more visible. When you actually look at where we were at for 22, steer slaughter was actually down 2% year over year. Heifer slaughter was up 5%. And if you take that classic ratio of 2 to 1 steers to heifers on feed, the escalation and the full feed yard, the lack of pen space, all those conditions that we saw from the backlog of cattle during and coming out of COVID, the forced placements of cattle essentially throughout 2022 because of just poor range conditions outside the feed yard, that not only forced continuation of very aggressive placements and very aggressive total on feed numbers, but we were placing lighter and lighter cattle as we went along, simply because there was nowhere to go with them. So in short, we were borrowing ahead or forward placing those cattle led by the heifers, because there wasn't a soul interested in heifer retention. The point of that thing is twofold. One is, when we see this rollover of cattle on, we've seen the decline in placements starting in October, and expect to see that placement rate decline accelerate quite heavily. Early estimates for the December placement number and the December cattle on feed is for placements to be down 11%. And to go through an extended period of time of double-digit declines in that placement rate, and then the subsequently contraction and available market-ready fed cattle supplies, certainly through the second half of 23, is going to be a mega driver in the market. All right, so the remainder of these slides, I've tried to give a really quick overview of the macro situation, what were the drivers that got us into this shape, and now with essentially the remainder of these slides, I'm going to try to convert that information and what should it mean for price. And the regression that I've got up here, and I know that there's a lot of people just hate these things, but you know, you got to give us economists. We do have our idiosyncrasies, and we just love them. But you can see the trend line up there when we're looking at a calf crop number, basically at 33.3, and you just take the trend line of so. Calf crop in the cattle inventory report is the x-axis. What that means for 4 to 5 weight steer calves is the y-axis, and that gives us a projected average price for 4 to 5 weight steers this year, something $2.25 to $2.27 is the work that I did with that. The other point that I will bring up for those of you that don't look at these things daily, the R square on that. 1 is a perfect 1.0 would be a perfect correlation. So an R square of 0.823, that gives us an incredibly high confidence level that we're pretty, the reliability of the comparison of these two data sets. If you look at that thing, about 73 to 75% of a calf crop number will be in the slaughter mix the following year. So say with somewhere in the low to mid 70s of that calf crop number to slaughter is what gives that confidence factor. So if we're looking at a 2.25 average calf price for the year, what's it going to look like as we trade our way through the coming year? I think the market, and this one is pretty legitimate, as where we ended up 2022 on cash prices is just this little bitty slice of cash trade out here. But the interesting market to observe will be, typically we will see that the strongest part of that calf market between now and that March, May window, as guys are trying to buy calves for grass. We'll see, we'll trail off through the summer, and then we will see some ramp up back there late in the fourth quarter. I think seasonally we're going to follow the pattern very closely. The thing that I would probably argue from just how the price forecast lays against the historical, as I've talked throughout the conversation today, as numbers start to tighten, they're just going to continue to tighten. So if I were to try to poke holes in this forecast as it lays out today, I would say that we will probably see stronger prices start to develop during the third quarter and probably see higher prices during the fourth quarter than what this price forecast implies. But I think the conclusion for this slide is not only ourselves, but basically market analysts throughout the industry have been promising for the last year to 18 months that there's help on the way for the cow-calf guys. I think we're finally to that point that we're seeing that help proven in the marketplace. All right, so I'm going through the same the same exercise, but at this time I'm taking a different view. I'm taking the fed steer price, converting it to dollars per head, to get there, I just took the average annual average price for fed steers against the average live weight, and subtracted the value of corn for that particular year, and I run the ratio to feeder steers. This one is even a higher R square value than we see on the calves, with an R square of a 0.93. So I'm really not going to try to pull a lot of comparison here when I'm looking at fed steer prices on a $1 per head basis minus corn. We could convert those back to live per hundredweight, but on this one, we're thinking an average price on feeder steers this year, that $1.97 to $2 range. If I were to make a comment on just the outlook for this market, and I say I know this, I don't know that, but my perception is certainly the majority of producers in the Nevada marketplace are calf sellers. And my point with this one, if there was ever a time that you guys were going to look at retaining ownership, certainly through the backgrounding phase, I think that 2023 could very well be, and probably again in 24 would be years to implement that retained ownership strategy. I think there's that much room to come in the market. And if you put this in comparison, we're working. Well, I'm going to move forward. We're working with a CME Feeder Index today that is roughly $1.80. So my biggest challenge with this forecast generated in this slide is, how am I going to get steer prices from the $1.80 today up into that strong 190s level, and then what does that do for prices as we go out for the remainder of the year? So what I'm explaining here is I torque this data for the first half of the year in order to get a price forecast for the second half of the year that I think will really be representative of what we're seeing paid in the marketplace. So either I'm looking for another $10 to $12 rally sometime here in the spring in really short order. I think the structure's in place to do that. And partially why I'm saying that is, again, reflecting on the drought, the amount of winter grazing, either wheat or oat grazing, that we do predominantly Oklahoma and Texas, Kansas, the numbers turned out for winter grazing this year are incredibly low. And when we went through the fall period and were forced to find a home for those calves, we've already talked about a lot of them went straight into a feed yard, and that inflated our placement rate through the fall. I also think that grow yards are chock full of cattle, and we will see those cattle come starting the second half of February and certainly through March. And typically, when we see those winter graze out cattle are turned out ideally in early November, and stay out on that wheat until March, early March, if they intend to cut wheat. And then if they just graze out that wheat, those cattle can stay out there till May. We've had enough precipitation through the Midwest for wheat that was planted that we could see some spring grazing opportunities. That's usually pretty thin when it does happen. If I'm going to try to stop rambling and just, okay, so what does that mean? I think that we could see a pretty good number of cattle as the backgrounded cattle move second half of February and March. But I think the real transition in this market will likely come in that March-May window when we simply don't see the number of winter grazing cattle that normally come. If we see that spike in the market here, then it's obviously going to give us a higher confidence factor or more loft as we go out through the second half of the year. All right, and then go through this exercise one last time, and this time I'm taking the relationship to the comprehensive cutout to the, and I've used the 5 market steer as my forecasting tool. And so the y-axis is where I have comprehensive cutout values and what that means to fed steer price. I will, that's still 0.60 is the R square. That's not as high a number as clearly what we saw with the other samples, but it's still a reasonably reliable number. And you can see with the spread on these prices that it's just not the correlation that we had with the others. But with that said, we're looking for a annual average price for fed steers in 2023 between 157 and 160. And I might be a little bit overly optimistic thinking that we could see a 160 average, but you just run this thing out from what we think we'll see in cutout values, the demand base that we have seen through in the wholesale beef trade throughout November and December, not completely counter seasonal, but a very strong demand base held in there. I think we've got some justification. So anyway, a projection for an average fed steer price, say in that 157 to 160 level. Again, this is when I do the price forecast derived from percent of annual average, and we've seen 160 on a delivered basis. We've seen a weighted average steer price the last 2 weeks between 157 in the Plain States, 157.58 in the Corn Belt. So I'm starting from a very legitimate price point on where I'm starting the years. One thing I pointed this out in both calves and yearlings, but it's clearly more apparent, is normally we will see that high ebb in fed cattle prices sometime between that Feb-April window. And the drivers behind that is that's when our available fed cattle supply is its tightest. And it is when we see all the opening of that spring grilling season to drive up the demand for the middle meats that supports cutout values, and so that's that typical spring market. Because of that available supply of fed cattle, I think that we will very likely see a fourth quarter high next year easily take out the spring high, and we could see, be saying something in that 170 to 175 for an extreme high as we get late in the year next year. The other thing that I think I didn't get slides incorporated into, but I would like to talk about just a bit before we go into Q&A. But beef demand has continued to be, I'm going to categorize it this way. I would categorize beef demand in 2021 as straight out excellent. I think for 2022, I'm still going to call it very good, but we're seeing evidence of some consumer stress, as I talked at the beginning on the macro market. We've seen some softening of demand both on middle meats and on ground beef prices. The middle meats really didn't come as a surprise. What has surprised us is to seeing some softness in ground beef prices, particularly when we see certainly some verbal evidence, if not actual evidence, of consumers starting to still have a very strong appetite for beef and animal protein collectively, but they're still wanting to have that protein fix with their meals. But we are seeing evidence that they're willing to trade down the individual items that they're buying when they go to the grocery store. All right. The other point that I would like to talk about a little bit is the growth we have seen in exports over the last 3 years has been phenomenal. And the first point of that is that month in, month out, 70 to 75% of U.S. beef exports go to Asia and Southeast Asia. I think one way to look at that is we've got a lot of eggs in one basket. I think the broader way to look at that is that we're in a very mature industry. Our only real opportunity to grow the size of the pie is to escalate those exports, and we've gone from a BSE episode there where we saw pre-BSE exports were about 8 to 10% of production. We went to 0% of production overnight, and from that period forward, we're now seeing exports as a percent of total U.S. beef production, something in a range of 12 to 15%. There's some discrepancy in that. The textbook way to calculate that exports is against carcass weights. USMEF adds the variety meats in that equation because they're so important to our total export dollars. So that gives us that discrepancy in percentage between 12 and 15. All right, so exports for the year, beef exports are up 3.5%. After exports to China in 2022 were up 22% over what they were in 2021. That doesn't, it doesn't take a lot of looking at this. If total exports were up 3.5%, but China was up 22%, China is the 900-pound gorilla in the room when it comes to growth in exports. When we look at the big four customers we have on exports, it's still very much the same. Japan continues to be the number one importer, both on a volume and dollar value basis. South Korea is now often number two. We'll see Mexico and South Korea kind of bounce for second place. China is now number three. And as I've had conversations over time with some of the large importing companies or the state buying agencies for China, they're very open with me that they have every intention that China will ultimately be the U.S. number one export customer for beef. So if you look at the demographics issue in China and the complications that's going to cause over time with the lack of ability of consumers, the lack of ability of labor. If you look at the current housing situation that they've had in China, that in turn has led to, on a regionalized basis, some run on some banks. And then certainly the big one that we're seeing in the news every day now is just the runaway explosion that they have with COVID, the death loss associated with that. I was having a conversation with an exporter on Friday, and they were giving me a more positive spin on China COVID situation than what we're seeing on the news. And what they were saying that Beijing and some of the cities that were the first to really see COVID cases explode, they've already started to flatten off, and they think they're on the backside of that whole exposure. I think you're still talking some of those secondary cities and some of the rural areas. I think they've got a ways to go to fight COVID. The complications they have with their vaccine simply doesn't work on Omicron. So I don't want to say it's gone away, but I am getting impact or comments from the exporters that they think we're really close to the ebb of the COVID crisis in China, and we'll see it start to contract. All right, so I started off with talking a little bit of hesitation or concern with that we have to keep an eye on the macro market, and that's going to be our Achilles heel as we go through 2023. But if we look at the decline in cow numbers that we've had over the last 4 years, the expectation that we'll probably see very modest but continued cow liquidation in 23, taking us to a beef cow number below that low ebb of 2014. We're looking at reduced cattle supplies not only for 2023, but the real impact of that, and as we earnestly start heifer retention, our tightest supplies of cattle is going to be 2024 and 2025. So I think that the long-term view of this thing is incredibly bullish. If you look at the, let's just say $15 to $17 per 100 rally we've seen from early fall through the end of the year, I have some hesitation that we're so gung-ho and so optimistic with the rally that we're starting a little rambunctious. That could easily set us up for some kind of a correction. But the real takeaway from this is we've talked through each weight class of cattle. We're looking at incredibly good average prices for the year, and even better average prices as we go through the next 3, even 4 years. And so just the last repeat I'll make, our annual average prices forecast for the year, we're talking an average calf price at 2 1/4. We're talking feeder steer average at just at or under $2, and looking for a fed steer price $157 to $160. And with that, I'm going to pause, and I will be happy to answer any questions that come through.
Don, I would just ask this question, because this is one that always comes up in any of these types of presentations that you've done that forecast meat demand and other things, and that is, what are the plant-based and cell-based meat substitute demand trends? What do they look like as they're tracking regular, real meat demands that you've outlined?
I'm going to give a politically correct answer here from what I'd like to say. We've seen with the sales of those products, and we've certainly seen with the erosion in both sales volumes, total sales revenue, and stock price with Beyond Meat. That company is under a lot of stress, even for survivability. Now, they did just come with the announcement last week that Beyond has finally created what they're calling a steak product that I think is more like steak bites instead of a steak. but that product will be offered in a number of Costco locations. Excuse me. So I'm not going to count them out. I think that if you looked at just the barrage of companies that introduced plant-based products over the last 5 years, I think we're to a point we're going to see some very aggressive consolidation in that space. It's such a small slice of total protein consumption. It is not a big issue. I have, we saw a no more questions comment from the FDA for one of the lab-based companies. There were stories last week about U.S. and China counterparties meeting to discuss the inspection and production process for the lab-based products. So from meetings that I've been in, I think they've got a long way to go before they can scale up the production of the lab-based products. But I do think we're to a point we need to separate the discussion from plant-based and lab-based, but both of them, they are so minutely small that they don't really, I'm going to say matter. They do matter, but they're not impacting conventional production.
They're not really changing any of the demand, and that's sort of the answer that I'm getting from a number of folks as well, is that the use of those products even up until now are primarily to substitute for what they were already doing for a salad night. Yep. So it's really not hasn't been impacting the demand for real beef.
Yeah, and I think that we're seeing some stories that as though we saw that flurry of sales and the new product excitement there 3-4 years ago. As retail sales just steadily contract, not only are we looking at the consolidation of the industry, but we're also seeing retailers that are now trying to figure out how to take less of their freezer or cold space to offer those products and put conventional products back in. So they deserve it.
I have a question here and I'll just read it. Will there be help in ag loans to help with risk to help ranchers that need to get started again? So in essence, will there be some products from ag loan institutions, both I guess federal and private, government and private, that can help with ranchers that kind of really need to get rolling again after some of the problems that we've had?
I'm going to answer yes, and I'm also going to give the disclaimer that yes, technically I do work for a bank, but you got to understand I know nothing about banking. And with that disclaimer given, I think if you look at the very, very aggressive investments that USDA has made in small and regionalized processing over the last 2 years, they even got putting some money in some sizable new construction of facilities. I'm going to say I wouldn't in any way be surprised to see USDA support and just the whole mindset of the recovery efforts of the current administration. I will say this on the banking side. I'm going to say yes, and I don't know to say if that is new products with an extended payout period, or if that's a lot of cooperation from lenders under existing loans. But I think that you will have a very cooperative environment to work with.
Great. We have any more questions that have filtered in? I do have one more here. What, in your crystal ball, what does the future look like for food, for eating out or delivered versus eating at home?
That's a great question. And this is much to my surprise, but what we have seen so far is that return to from the 2 years that we were shut down from COVID and forced to have an escalating number of meals at home. That trend seems to be sticking. The side story with that one is when we shut down the HRI, hotel restaurant institutional business, and within a 2-week period, industry had to figure out how to get that upper 1/3 of choice and prime product from the white tablecloth trade to conventional grocery stores. What we've seen from that is the proliferation of people who had more time, and when they were at home, they couldn't go out to eat. They couldn't go out to the movies. The malls were shut down. They elected to reward themselves by eating better at home. And with the ability to buy that high quality product and ultra high quality product at the local grocery store or specialty butcher, those sales took off. And that trend we're seeing hold at this point in time. But if we do get into recessionary pressures that I talked about earlier, is that going to dampen the demand for that high-end product? We're yet to see, but if you look at the choice select and the prime to comprehensive spreads, that demand for that high-end product is still very much in place. So I'm going to say meals at a long answer to meals at home have really gained momentum.
Great. I'm not seeing any additional questions here. Getting the all clear here. So what I want to do then is thank you very much, Don, for your time and your expertise in joining us today. And we thank you very much, and hopefully this trend will continue. And I don't know, I've never seen as many, just anecdotal, I have never seen as many rib roasts bought and eaten over this group of holidays that I have seen in my life. It seems like every time I got drugged to the grocery store, people had rib roasts in their baskets. So hopefully that trend will continue. I had one as well, or actually we had a couple over the holidays. So good news on the short term, and at least on the medium term anyway.
Thank you very much. It's a pleasure to be with you, and keep catching that rain.